That's why I'll say, even though there's a pullback right now in gold, go and look at the Swissy gold chart, and I consider the Swiss franc probably one of the more semi-serious fiats. Go and look at the Swissy gold chart. We've just made some number of macro targets. There will be a slight pullback, but it's going to go higher in my view. So that's where the money's going. If you look at the market caps of the US relative to the rest of the world, my net opinion is those relative market caps are going to come chronically down in America, and you're going to see other market caps. I see indices going up in emerging markets. I see it in Singapore. I see it in other capital formation nations. America's going to lose market cap to the rest of the world in equity. So I think there'll be a geographical flow. If we're just staying in equities, there's going to be a geographical flow away from the US still because of the tariff. You can only scare people like they did with the tariff tantrum once, and trust is eroded. They did long-term damage on trust.
The speaker, Francis Hunt, notes that while gold is experiencing a slight pullback, it's still on track to move higher, especially when measured against stronger currencies like the Swiss franc. He believes capital flows into gold and emerging markets, not U.S. equities. He predicts U.S. market dominance will decline as trust has been damaged, particularly by past tariff policies. Recent news shows that investors like Ray Dalio are already shifting, as seen with Bridgewater's $320 million investment into gold. The speaker, Francis Hunt, argues that investors are stuck in an outdated mindset, flipping between stocks and bonds in a classic 60-40 portfolio model. Big names like Druckenmiller and Paul Tudor Jones have been shorting bonds, seeing them as poor investments due to low yields and rising default risks. Instead of chasing returns in bonds or U.S. equities, which he believes are overvalued and losing global dominance, the speaker suggests smart money flows into gold and, increasingly, crypto. He sees a global shift in equity market strength from the U.S. to emerging markets. Ray Dalio is praised for consistently investing in gold as a reserve asset. Warren Buffett's recent cautious remarks and step back from Berkshire hint at declining confidence in America's economic future. Francis Hunt argues that too much focus is placed on stocks, primarily by retail investors. While short-term stock movements are volatile, the real story is in the bond market, which drives the broader economic trend. Many corporations like Coca-Cola have taken on heavy debt for buybacks and dividends, making them fundamentally weaker despite higher valuations. As interest rates rise and deleveraging begins, companies with high debt loads will struggle. Job losses, like those at Microsoft, signal deeper economic trouble that will eventually hit the housing market and trigger defaults. The speaker warns of an approaching phase of rapid debt and currency devaluation, which won't be obvious when comparing weak currencies against each other, but will be clear when measured against gold, which he sees as the actual benchmark. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
If you look at the market caps of the US relative to the rest of the world, my net opinion is those relative market caps are going to come chronically down in America, and you're going to see other market caps. I see indices going up in emerging markets. I see it in Singapore. I see it in other capital formation nations. America's going to lose market cap to the rest of the world in equity. So I think there'll be a geographical flow. If we're just staying in equities, there's going to be a geographical flow away from the US still because of the tariff. You can only scare people like they did with the tariff tantrum. Ray Dalio at least is consistent, and he's buying a reserve asset. And he's very concerned about the bond reserve asset that's finished its 40-year period of being a reserve asset. So I think he's consistent. Warren Buffett is stepping down, and he's chosen this year, and he spoke the words. This is Captain America, who said you won the lottery by being born in America. This guy's never been a bigger nationalist and patriot in terms of all his financial commentary ever. And he's stepping down, and he's admitting that his successor is likely to be more internationalist, and he's expressed concerns about the state and valuation of the dollar, and he's also made comments about the trade deficit and the overall debt levels. So you're talking about a man who's signing off more pessimistically than he's ever been by a multiple of about 10 times. So for your Ray Dalio, I think he's doing exactly what he sees, and I think he's right. And Warren Buffett is no longer wants to be the guy running Berkshire and investing offshore and saying America sucks. He never wants to be that guy. Who knows? He might become very unpopular and get tax audits if he did it. He's leaving it to his successor to set a new vision and pursue a new path. The most retail thing is to over-fascinate on stocks. I'm not actually strongly anything short, medium term on stocks. Long term, the most interesting market is the bonds. The bonds is the dominator and the leads. So when someone will ask you about a stock market, I say, in due course, deleveraging takes its course on the stock market too, which is down. Because you've got corporates. At one point I had a stat, I don't think it's an up-to-date stat, 15% of the S&P 500 was borrowing to pay dividends. Why? Because at the time, the cost of borrowing was much lower than the cost associated to equity ownership. So now imagine, once you start deleveraging and the long-term rates are going like that, you're going to have equities that are going to be sitting with highly leveraged balance sheets. I once saw there was a very good article that compared Coca-Cola to Coca-Cola a decade and a half ago. And in actual fact, it does less revenue, less earnings, loaded up on way more debt on buybacks. And actually is a lesser company, but was trading at 2.5 times what it was 15 years ago. So the point is that mathematics inverts. And that's what's going to be long-term negative for the stock market. Right now, when we have an absolute fear moment brought about by the tariff tantrum with a subsequent hyper-normalization reactionary moment, this is just chop and volatility. And as I say, focus on the debt markets, focus on housing, focus on jobs. Unemployment is the final shoe that drops with this, and we're already seeing Microsoft letting go a lot of people. That's a lot of high salaries coming off that now want welfare on earning, on going to be making mortgage payments, etc., etc. And those things bring the whole can down. And then there's only one way for the stock market, down. Right now, when you're getting a little bit of liquidity fed in, you can have a natural reaction back up. But long run, we've got to unleverage. But when I say down, you've also got to remember the dollar's going to go into that convexity period where it's spilling super fast. All debt, as it devalues, it's kind of like a mortgage payoff chart. It's like this, and then it gets suddenly very vertical. We're at that point where things are about to accelerate in debt devaluation, which is the rates, and it's going to get sudden and fast, and it's going to be also currency devaluation because money's borrowed into existence. The only reason most won't notice it, it's already happening to a degree now, is we compare dollars to euros. We all synchronized lepers in the leper colony. You've got to compare it to gold. And that's where we come to gold.
Francis Hunt argues that the Federal Reserve is trapped. It can't cut interest rates without signaling economic weakness, nor can it raise them without worsening debt pressures. The U.S. is in a debt-based collapse, with trillions in debt and very little real savings. Cutting rates implies asset values are still strong, which contradicts the reality of over-leveraged consumers, municipalities, and states. The Fed is powerless now, boxed in by decades of bad policy and massive overexpansion. Globally, it's not just the US. German and Australian long-term bond yields are rising, and housing markets are set to suffer. Yet, the one major issue no one is addressing is bank health. Banks are at high risk of crushing consumer debt, defaults, and falling property markets. And the lack of attention to this is alarming. Insiders are profiting massively from political and financial chaos, with examples of suspiciously well-timed trades by figures like Pelosi and others before major market moves, highlighting a corrupt cacocracy. The real economic shock came during Trump's peak tariff moment, when U.S. bonds and the dollar collapsed simultaneously, an unprecedented signal of lost trust in U.S. assets. Though markets have since rebounded, that moment was a critical warning. It showed what a loss of faith in American financial leadership looks like, and the speaker warns that this was only a glimpse of deeper systemic cracks that will resurface more forcefully shortly. Now, let's get back to the interview.
When you say the Fed, everybody assumes that the Fed gets to determine the interest rates. And again, I refer you to literally the opening state. It's a debt-based collapse. Because for the Fed to be able to set the rates lower, you're actually saying, well, this asset is now worth more. And there's an absolute plethora of it. They've got $9 trillion to roll. They haven't. That's not including the additional expenditure that are gone. In truth, the doggy savings that you've been told about are minuscule. And if you look at it in a big time frame curve, there's no real meaningful adjustment. Not that I'm going to say if any efficiency is a bad thing and culling a lot of the bulb products, but this is nickel and diming. It's saving. It's pence.
You're saving 10% or whatever it is.
Pence wise and pound foolish. The big money is the problem. And so as a result of that, he doesn't have the power to cut rates. In fact, the Fed's never been more clearly boxed in. They need actually, for the debt to be devalued, they should, on that behalf, be comfortable with raising rates. Think a Volcker upswing that was at the 80s. But in terms of the economic health of the consumer and the nation and the state of bankruptcy that I imagine many consumers are in, many municipalities are in, many states are in, they can't actually do those cuts because there's no bid on the debt. So this is all about the reserve assets that was afforded to bonds that ended with the 40-year bull market. He doesn't have the power. He's boxed in, caught between two fences. They damned which direction they move. They're going to trip the wire and the limpet mine goes off. So it's almost like frozen in the headlights right here, because then at least I can't be blamed for something is unrescuable situation, and he is got the guy holding the bag for Greenspan, Bernanke, Yellen, and all those that came before him that allowed government over expenditure, ran too lower interest rates, and ran an asset price hyperinflation. Just because we globalized and we had low consumer inflation. There was still inflation. The liquidity just found its way into assets on debt. So now we actually have to reverse that day into a night, which is everything gets flipped on its head, and it's deeply unpleasant. So we're predicting, asset price devaluation, and the long end of debt is going to cause, and it's not just America, by the way, because we're talking a lot about the Fed and everything else. I'm going to be showing today tomorrow it is my speech, that the German long rate is going to go higher and is going to go to 4%. I'm going to show that the Australians hitting for 6%. Now Australia glided through the GFC on their property market. I'm saying not this time. So housing is going to be chronically affected. But everything that does that is the amazing word that no one's mentioning in all of this is the word bank. Nobody's speaking about bank health in this environment. You've got crushed consumer, you've got defaulting credit in just about every category. You're going to have a contracting housing market, and yet nobody's talking bank. That makes me distinctly nervous, because that's where the spotlight's not being shone, and those are the areas I worry about. I'd imagine the trading rooms there certainly seems to be a cacocracy of insider trading. I mean, I'm posting on Twitter, best trader in the world #1, best trader in the world #2, and we have Nancy Pelosi, we even have Marie Green. They were buying into Palantir just before they go up 60%. Apparently the Middle East are going to be putting in 300 million into Trump token. So crypto is going to become this cacocracy. Interestingly, the Economist had as a leader the crypto swamp. So Trump is getting enriched through this. I mean, these insiders all around them, we are watching absolute skullduggery and cacocracy and malfeasance and financial fraud for the insiders, without a doubt. And you see inordinate sums buying expiry on the day call options that are near worthless, deeply out the money. That's assuming they weren't already to start.
That sounds like degenerate gambling to me, to be honest. But
well,
sure.
When you have the insider information, it's almost a sure thing, isn't it? There's a reason there's been real volatility in the predictions, and that's because we had real volatility. We had an earth-shuddering moment, and the key earth-shuddering moment came about, Kai, is when peak Trump tariff tantrum. What actually happened is the bond market collapsed, rates shot up, and the dollar went down. That was the first time that ever happened meaningfully in the US. By the way, it fulfilled the prediction that we'd made when the same thing happened in the UK, something I'll be reminding people in our chat as well with. Wedding party, let's just say. And at that point, while that happened, you saw a flight out of dollar and a flight out of treasuries. And that was a very, very short, sharp slap on the face for Donald Trump, which he later said, I wasn't afraid about the bond market, which I interpret to mean he was afraid about the bond market, or someone who explained it to him told him he should have been afraid about the bond market. So suddenly they reined that very harshly back and renormalized. So during the period while we were in that peak de-dollarization, suddenly isolationist American moment, he suddenly came back out and said, let's make friends, let's work together all again. And they quickly reversed back that line. So it was they tested the line, they got a very hard slap. Now, a lot of those predictions of 90% recession for the US were being made in the heat of dollar losing value and the bonds losing value simultaneously. Now, suddenly, the ability they've shown to actually reflate and normalize, which has been quite spectacular as well, excuse me, has seen everybody rein it back. So everyone panicked with the panic, and everybody's gone, hey, we're back to everything hunky-dory. Neither is right. The people that are thinking they're back to hunky-dory, you just saw a flash of the future in a small microcosm moment. That comes back again. So remember, the guy who predicted it when it happened in the UK, that said it's coming for America, it's happened once, you've had 5 minutes of it. Now wait till you have a full day. Now wait till you have a full week of it. It will come back. So I'm afraid that this is the beginning of drama and a first test. It's a fight where we've stood each other off in the pub, Kai, and you thought I was a wimp, and you marched right up in my face, and then next thing you know, I gave you a short, sharp slap.
You're good in judo.
I'm a ninja. I'm an absolute ninja. And then you got over your slap, and you thought, okay, hang on, you had another beer, and you got strong again, and you're coming back at me. And this time I'm going for the Jedi 5-finger punch to your chest. So that's the scenario where, and I think everybody thinks, that it was all over, and that it's back to normalization, and we can rein this all back. It isn't.
In short, Hunt paints a picture of a world quietly rotating away from the old 60-40 US-centric playbook. He sees a trust gap opening. Sovereign bonds and dollar-denominated assets no longer feel risk-free. Highly leveraged blue-chip stocks are debt in disguise, and the Fed can't fix it without breaking something else. Meanwhile, capital is slipping toward real asset havens, gold first, then perhaps crypto, and toward equity markets in fiscally stronger, faster-growing regions. If that migration accelerates, the next bout of volatility may look less like a garden variety correction and more like a regime change in where and how global wealth is stored. If large-scale bank stress surfaces, which metrics or early warning signals would you monitor first to gauge its severity? How might a sustained shift of market leadership from the US to emerging markets reshape an everyday investor's portfolio strategy over the next decade? Drop your thoughts in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed.